made his name betting against the housing market.
Imagine you could predict the biggest financial collapse in decades. What would you do? Would you seize the opportunity or would you just let it slip? Michael Burry did just that. His story is fascinating and incredibly relevant to the lessons we can learn today. Burry is known for his unique investment strategies and unorthodox personality. He made a name for himself by betting against the housing market when everyone else was riding high. In this video, we will explore Burry's investment philosophy and how he identified the flaws in the housing market that led to his famous Big Short. So, buckle up and get ready for an insightful journey into the world of Michael Burry and the Big Short. Who is Michael Burry? Michael Burry was born in San Jose, California on June 19, 1971. He attended the University of California, earning an undergraduate degree in economics and pre-med. He obtained an MD from Vanderbilt University School of Medicine. He began residencies in neurology and pathology at Stanford University. During his medical education, Burry developed a passion for investing and spent his spare time studying the financial markets. By the mid-1990s, he had already established himself as a savvy investor, often publishing his opinions and predictions on his blog and investment forums. In 2000, Burry left medicine to focus on his true passion, investing. He founded his investment fund, Scion Capital, which quickly achieved remarkable success. As the S&P 500 fell by 11.8% in 2001, Scion Capital returned 55% to its investors. As the S&P was down 22% the subsequent year, Burry's fund grew by 16%. The housing bubble. As the internet bubble bust and the financial market crashed, investors withdrew from the stock market and invested in property. During this period, the Federal Reserve reduced the cost of borrowing. The move was to tackle the economic slowdowns that preceded the dot-com bust, also to mitigate uncertainty after the 9/11 terrorist attacks. The surge of money and credit resulted from different governmental policy measures. It aimed to encourage home ownership and uptake of innovative financial market instruments. This was to improve the liquidity of real estate assets. In the early 2000s, the housing market was booming, and it seemed like everyone wanted to get in on the action. Traditionally, the property markets were less prone to crises than other financial vehicles. This is because of the massive transaction and carrying costs related to home ownership. However, providing easy access to credit by reducing interest rates and easing credit evaluation standards fueled demand. This is precisely what occurred during the early 2000s. How the bubble grew. In 2005 and 2006, banks granted around 20% of mortgages to people who did not meet the standard criteria for borrowing. These individuals were labeled subprime borrowers. Over 75% of the subprime loans were adjustable rate mortgages that commenced with low interest rates, but were scheduled to reset after 2 to 3 years. The government's push to increase home ownership made banks reduce interest rates and loaning requirements. This resulted in a home ownership frenzy surge, pushing the median home sales by 55% from 2000 to 2007. Burry realized that the lending criteria had declined and reached the absolute bottom. The loan with an adjustable interest rate that offered only interest payments and negative amortization was the most extreme example of this decline. Banks allowed home buyers to pay nothing and roll whatever interest they owed into a higher principal balance. Michael Burry couldn't understand why lenders would want to extend such a loan. He believed it was up to the lenders to show restraint, and when they lost it, the market was in trouble. By 2003, Burry knew that the borrowers had reached rock bottom, and by 2005, banks had surpassed their limits. The subprime mortgage industry had a unique ability to confuse what needed to be clarified. For example, if the underlying assets of a bond were subprime mortgages, it was not labeled as a subprime mortgage bond. It was labeled as an asset-backed security, or ABS. If you inquire with Deutsche Bank, the asset secured an asset-backed security. In response, you'd receive lists of unfamiliar acronyms, HELOCs, RMBS, Alt-A, HELS, and other credit categories you did not know existed. Remember to share and subscribe for more videos about the realm of finance. Burry's investment strategy.
I called up the prospectuses and I read the prospectuses and I looked at these pools. I could see the credit standards within these pools deteriorating, just quarter to quarter.
Burry stood out from the crowd as an investor by developing distinctive approaches. He viewed himself as a value investor who used the margin of safety principle to guide his investment decisions. In the early 2000s, while researching potential stocks to invest in for his clients, Burry observed that the bond market took in an enormous amount of subprime mortgage loans. Burry dedicated himself to finding the most profitable investment, which led him to delve into the bond market for the first time. He invested considerable effort in understanding the borrowing mechanisms and lending money in America. Specifically, he focused on gaining knowledge about subprime mortgage bonds. After examining mortgage-backed securities proposals, Burry discovered that the property market offered massive high-risk loans. The industry was extending high-risk mortgages to individuals who could fail to repay the loan. Additionally, the reports indicated that many people were experiencing difficulty paying their mortgage payments. Upon further observations, he realized that a significant amount of credit worth millions of dollars in the market was artificially inflated and held very little value. Michael Burry came up with a phrase to describe the situation: the extension of credit by instrument. This is because people couldn't afford to pay their mortgages. So, lenders were creating new financial instruments to justify handing them new money. Banks were lowering their lending standards to increase loan volumes. They then sold the loans to financial institutions such as Goldman Sachs, Morgan Stanley, and Wells Fargo. In turn, these investment banks would bundle them into bonds and sell them to investors. Burry believed that the investors who bought these subprime mortgage bonds were unsophisticated and unaware of the risks involved. He assumed the end buyers of subprime mortgage bonds were just dumb money. The Big Short.
So how much of these things did you buy? I mean, you got out of everything else and bought credit default swaps betting against the housing market, right?
Right, we bought basically short $8.4 billion of credit default swaps related to mortgages or financial companies.
As early as 2005, Burry believed that subprime mortgage loans would likely become non-performing assets, but he knew it would take some time before they did. Despite this knowledge, Burry decided to take a risk and invest in these loans. He anticipated that the market would eventually adjust and improve the odds in his favor. In other words, he made a calculated bet and was willing to wait for his gamble to pay off. So, the subprime mortgage loans issued in early 2005 were most likely destined for default. However, these loans did not reset for a couple of years due to the artificially low interest rates. These mortgages typically had adjustable interest rates, but often started with a fixed teaser rate for the first 2 years. For example, a mortgage was acquired in 2005 with a fixed rate of 6% for the first 2 years. It could suddenly skyrocket to 11% in 2007, leading to a surge in loan defaults. The loans were like time bombs, and as time passed, the soft ticking of their risk grew louder until it was evident to many. Once people realized the danger, no one would insure subprime mortgage bonds. Burry took a risk, but he faced an investment problem. All the subprime mortgage bonds were unsuitable for short selling. While buying or selling the bonds was possible, it was impossible to bet against them explicitly. On March 19, 2005, Burry had an idea: credit default swaps on subprime mortgage bonds. He had discovered credit default swaps a couple of years earlier. A credit default swap is an insurance policy. Credit default swaps involve periodic premium payments and a fixed term, usually for a corporate bond. Burry recognized that by purchasing credit default swaps, he could eliminate the issue of unlimited risk. This is because his potential loss would be predetermined and guaranteed, while his potential gain could be significantly greater. Burry believed he could make a profitable bet against groups of subprime mortgage loans by utilizing credit default swaps, CDS, which function as a type of insurance for corporate loans. He convinced investment banks to generate credit default swaps for the loans. When the underlying loan pools for these bonds started to fail, the investment banks who took a gamble on the subprime mortgage loans would send Burry money each day as the bonds continued to perform poorly. Michael Burry's legacy. One of the most important legacies of Burry's actions is the increased scrutiny of the financial industry and its practices. His successes predicting and profiting from the housing market crash has highlighted the need for accountability and greater transparency in the financial sector. Burry's actions and those of other investors profiting from the financial crisis led to regulatory reforms. This was to prevent similar crises in the future. The Dodd-Frank Wall Street Reform and Consumer Protection Act was passed in response to the financial crisis. And there you have it, folks. Michael Burry's The Big Short reveals how one man's analysis of the housing market risks led to a profitable investment opportunity. As it turns out, Burry based his investment strategy on sound research and attention to the market's underlying risks and potential vulnerabilities. What do you think of Michael Burry's story? Do you think he made the right call by betting against the housing market, or could he have pulled the plug and warned everyone? Share your thoughts in the comments below, and don't forget to like, share, and subscribe for more fascinating insights into finance.